India Inc. is heading into the fourth quarter of FY26 earnings season amid geopolitical tensions, uneven demand, and rising costs. Profits are likely to remain muted for banks, FMCG, industrials, pharma, and electronics manufacturing services, but strong in domestic auto, metals, and retail. According to brokerage estimates, net profits of the Nifty 50 companies are expected to grow just 4.2% year-on-year in Q4 of FY26 compared to 7.6% in the fourth quarter of FY25. The FMCG sector is showing early signs of recovery. Growth had slowed in Q3 due to GST-related inventory and pricing adjustments, but these effects are expected to reverse in the fourth quarter. Volumes are now recovering gradually, led by sustained improvement in rural demand. Organized channels like e-commerce and quick commerce are likely to outperform, while general trade remains slower. The IT sector is expected to deliver a subdued quarter in the fourth quarter of FY26, according to Kotak Institutional Equities. However, a sharp depreciation of the rupee is likely to drive double-digit year-on-year earnings growth for many companies. Consumer durables companies had a mixed quarter. Higher input costs due to the West Asia conflict and unseasonal rains in March impacted demand, especially for air conditioners. Sales of large appliances remained under pressure through the quarter. Overall, the sector is expected to see around 7% revenue growth, according to an analysis by HDFC Securities. The pharma sector is expected to remain stable, but growth will likely be muted. A report by Kotak Institutional Equities estimates 7% sales growth. The diagnostics segment is expected to outperform sectors like pharmaceuticals. Revenue growth for major listed players is expected to be in the range of 15 to 20%. The sector is also less impacted by the US-Iran conflict as it is largely domestic focused. The auto sector is expected to see steady revenue growth. According to Axis Securities, strong domestic demand and GST-led tailwinds will support earnings. However, rising input costs may limit margin expansion. Meanwhile, metals could see a strong quarter. A recovery in steel prices and seasonal demand is expected to boost revenues and profitability. Cement companies are expected to post healthy volume growth in the March quarter. This is driven by stronger construction activity and government capital expenditure. However, profitability is likely to remain under pressure due to rising fuel and packaging costs. According to Motilal Oswal Financial Services, revenues may grow by around 10% year-on-year, with EBITDA growth of about 4%. Overall, Q4 is expected to be a mixed quarter, and with global uncertainty still high, corporate earnings growth is expected to remain uneven in the near term. Follow Business Standard for more such stories.